Hi there, good afternoon. You're watching the Mutual Fund Corner. I'm Mangla Malu. With me in the Mutual Fund Corner is Sumaira Abdi. Like every Tuesday and Thursday, this is a show where we answer all your mutual fund related queries. Before we do that, a quick look at the markets. Well, it's been a volatile day. While we're off the highs of the day for both the Nifty and the Sensex, the past hour we're seeing some bit of recovery from the lows as well, about 15-20 points from the lows on the Nifty. Most of that would be courtesy a couple of these IT names, Infosys as well as TCS, both of them currently at the high point of the day. But the big casualty over the last 1 hour has been the Bajaj twins, Bajaj Finance, which is lower on account of the company cutting its disbursement guidance for a couple of its verticals, and at the same time we have Bajaj Finserv, which is the holding company, which is at the low point of the day as well. Bajaj Finserv, remember, reports numbers most likely post market hours. First up, all the top stories, and then we hand it over to Sumaira. Market gives up gains in the last hour. Key indices trade flat, mildly off lows though. Mid-cap index fares a shade better. Reliance and Bajaj Finance drag, while Infosys and TCS support. Auto stocks, they're in focus today as the Federation of Auto Dealers tells CNBC-TV18 that 200 dealerships have shut down over the last 12 months, mostly in the passenger vehicle space. In results today, we'll watch out for Tata Motors, expected to deliver losses in both their JLR and the standalone business. Bharti Infratel surges, it's off 4% from highs as the adjusted results, they're in line with estimates. The street likes the increase in net tenancy after 6 quarters. ICICI Pro, on the other hand, surges as the value of new businesses gains 27% year-on-year, and share of protection is also sharply higher. Big management speak to CNBC-TV18. IDFC First Bank management tells CNBC-TV18 a big part of their corporate credit stress has already been taken care of. Also says they will return to profits in the second quarter, while UPL tells CNBC-TV18 that despite pressure in the North American business, they retain their revenue and margin guidance. Also say they will cut debt by 3,000 crore rupees by FY20 ends. And we have CNBC-TV18 learning that Subhash Chandra Garg has sought voluntary retirement after a major bureaucratic shake-up in the Modi government, where Atanu Chakravarti has been appointed as the new Economic Affairs Secretary, succeeding S.C. Garg. And with that, we hand it over to Sumaira, who has with her Manoj Nagpal.
Thanks very much for that, Mangala. Manoj Nagpal of Outlook Asia Capital joined in as my guest this afternoon. Hi, Manoj. Good afternoon. And, today we want to speak a little bit about how to remove sentiments from the process, scientific process of investing. But let's do it through queries, right? So our first query comes in from Shashi Kumar Singh, who has sent us a mail. So he is a PSU employee. And he says he has been investing for the last 2 years through SIP. So his cumulative amount is 14,000 rupees per month. He is investing in the Kotak Select Focus Equity Fund, the Mirai Asset Large Cap Fund, as well as the Franklin Prima Plus Fund. So he says his current portfolio is yielding him only between 6 to 7%. Now he wants to know if it is a better option to put money in the EPF. So probably increase the voluntary contribution to the EPF, which he says would yield about 8.6% per annum. So he wants to know what he should do. His term is 8 to 10 years. So, for the long term, we always tell investors that, equity via mutual fund is perhaps the best way to create wealth over the long term. But yet every time there's a, downturn in the market, there's some bit of volatility, people get jittery, and I don't really blame them. So how does somebody like Shashi, and there'll be many of them, actually remove sentiments from this, scientific process and be convinced to stay the course?
Yeah, so Sumaira, this is a very classical problem which we see that every time when there is a period of no returns or when there is, the market goes through a down cycle. Currently, the markets are in a very, very unique state. For the last 2 years, the headline index, Nifty, has been going up. So people have been getting the, assurance that the markets are stable. However, the portfolios have not been generating return. Yeah. So one of the classic things that at this point of time investors are asking all advisors is this, the markets are up. However, my mutual fund portfolio or my stock portfolio is either not made any return. So if you have been in the mutual funds in the last 2 years, you would have made an annualized return of around 4 to 5% depending on where you are spread off. If you have more of large caps, mid caps, small caps, depending. But a benchmark is 4 to 5%. So two things have emerged in the last 2 years. One is that mutual funds have underperformed their benchmark. And the second thing is that what most of the retail investors look at is that has my mutual fund given a return higher than the bank fixed deposit. Now here we have again seen that investors are saying that my returns from whether it's a SIP, whether it's a lump sum investment, has given lesser return than the even the bank fixed deposit. So that's why people are now asking this question: is it better off to go into either a bank fixed deposit or EPF or PPF? PPF, for example, is still giving up return of 8.4% tax free. So people are saying that, and now today equities are taxable. So even if you generate a return of 10%, you're still coming to the same level. So this question becomes a little psychological at this point of time. And honestly, most of the people panic at some point of time, withdraw their investments from equity and go back, and that usually is the bottom of the market. When you are investing in equities, as I always say, your horizon has to be around 10 years. If you're lesser than that, you should not be investing too much into equities. So as a process, what investors should really follow, Sumaira, is that the first part of any portfolio construction is not look at the end product. Which product should I choose? It should always be the first step. What's my overall asset allocation? What's my risk appetite? Now that is a process I always advise every investor has to go through, of understanding what is the asset allocation he should make, and after that keep allocating funds. So when I say asset allocation in terms of a retail investor, there is a fixed percentage of his overall portfolio there should be in debt, in equity, and real estate. These are the three broad asset classes investors choose. Most of the investors in India, if you were to classify India, a country, as a human being, it becomes like a very rudimentary investor who's putting all his money into debt or real estate. So when we meet retail investors, almost 80 to 85% of their portfolio, or maybe 90% of the portfolio, is in debt or real estate, and 10% is the equity portfolio wherein they want supernormal returns. We always try to advise investors that even if you make supernormal returns out there, your overall portfolio, it's not going to change. Your wealth or net worth is not going to change. So the way to create wealth is first look at that first step, assess your risk tolerance, and then go into product selection.
Okay, so that makes sense. So now for Shashi and his particular query, you'd suggest that he remain invested in the funds that he has?
So first of all is existing SIPs. The SIPs have just been started 2 years back.
Yeah.
And within that 2 years, as I said, it's been a unique situation, and he's generated 5 to 7% return, which is actually what any SIP has generated. One should not panic at such a point of time, and you have to remember that SIP as a vehicle can only give you returns if you invested for at least 5 to 10 years. Before that, please do not expect returns also, and then that is the point of time you will start earning reasonable returns. So step number one. Step number two, on your incremental corpus, as I said, you have to follow the process, assess your overall asset allocation, and then allocate money according to that.
Okay, the next query comes in from Shashi Dharan, who's written to us from Bengaluru. He says he's completed the lock-in period in the L&T Tax Advantage Fund and wants to know now what would be the value if you remained invested for the next 7 years. Have you brought your crystal ball? No, okay. So, Shashi Dharan, that's what we want to actually we want to make, is that it is not possible for anybody to predict, what will be the performance of a fund 7 years from now. Also, he says he is, he had invested about 1.88 lakhs. He has got 4.6 lakhs. Yeah. So one is, should he cash out? My query on his behalf is that should investors start looking not at absolute returns, but more at compounded returns, in terms of percentage, how much has been delivered over the period that he was invested?
Yeah. So now coming specifically, to this classical situation where we are in, people invest into ELSS funds or tax-saving funds which have a 3-year lock-in. And this is a very common question that people ask, that at the end of 3 years, now should I cash out or should I withdraw since the lock-in period is over? Absolutely, that's the wrong way to go. Well, if you're in a good fund, even if it's a ELSS fund, you should continue your investments, assuming that the fund is doing well. And, so just because the lock-in has ended, the question of whether to redeem or not is not the right way to look at it. You have to only question your judgment on whether to redeem or not if the fund is not performing as per your expectations, or you think that your goal has changed or risk tolerance has changed. So that's point number one. Point number two is that how is L&T Tax Advantage Fund that he has invested? As you rightly said, human beings are basically geared to think in terms of simple returns. They cannot think in terms of compounded returns, specifically when you think of longer periods of time. If it's a 1, 2, 3 years, simple returns and compounded returns are almost the same, slightly here or there. But when you start talking of 7 years, 10 years, nobody can really think or attune his mind. And even smart mathematicians or scientists cannot think it. So, it's no wonder that simple persons cannot. And that is one of the reasons, if you see a lot of people who sell, fixed deposits or chit funds, they convert the compounded returns into simple returns. So saying that your money will double in 7 years, they will say that hence you are getting 18% simple returns. Now that is the wrong way, because in a 7-year period the compounded return will be substantially lower than 17-18%. So obviously it's a little tough to think in terms of compounded return, but that's the right way and the only way one should compare 2-3 investments. Now coming to a specific question of Shashi. Shashi, you're in a good fund. L&T Tax Advantage Fund has a 13-year history. It has given a return of around 13% compounded right from beginning till date. So it was launched in 2006 as under the name of Fidelity Tax Advantage Fund. L&T took it over and now it's become the L&T Tax Advantage Fund, managed by Somendranath Lahiri, who's one of the very pedigreed fund managers, manages the portfolio with 50-60% into large caps, 40% to mid caps. Very astutely managed funds. We believe that you should continue in the fund if you are holding period of 5 to 7 years, and you can extrapolate. Nobody can extrapolate returns, rightly as Sumaira said. But if you were to use the same benchmark that it is given around 13-14% and go forward, you will end up with a corpus of between 7 to 10 lakhs, assuming that the same returns carry. Obviously, as I said, that past is no guarantee that it will continue in the future, but that's thumb rule you can use.
All right, and on that note, we'll take a very quick break. We'll be right back with MF Corner, and Manoj also stays on with us. Stay tuned.